So is it better to load up your Roth IRA with dividend stocks, a dividend ETF, or plain old index funds? What's up, you guys? Welcome back to the Average Joe Investor channel. I'm glad you're here. In this video, we are talking about Roth IRAs, but more specifically, we're talking about whether or not we should be investing into our Roth IRA with dividend stocks from the outset or index funds. But the caveat there is if we outperform with index funds and we want to transition to dividend stocks or a dividend ETF, can we then transition to dividend stocks and capture just as much dividend income as if we'd started with dividend stocks from the beginning? You guys know how I never want to waste your time. In fact, I like to deliver massive value every time I jump in front of the camera. So in the spirit of that, I'd like to get this video done and get you out the door in less than 10 minutes. So without further delay, hit that like button, hit the subscribe button, let's get started. Hey guys, before we get started, make sure to hit that subscribe button below the video to ensure you do not miss any future videos I post. Make sure to leave a comment below saying you subscribed, and I promise to respond personally to your comment. Alright guys, you're looking at my monthly dividend stock spreadsheet, and just as a quick reminder for those of you that are new to the channel, you can access this dividend stock spreadsheet, which is updated on a monthly basis to include all the dividend stocks that have been paying dividends for at least 5 consecutive years by clicking on the link in the description below for my Patreon community. There, I've said it, let's go ahead and jump right into the video. So in this video, we're going to test 3 different investments in a Roth IRA. We know that with a Roth IRA right now, current tax law states that you can't invest more than $6,000 a year. So we're not going to assume no catch-up provisions just to complicate the video. We're going to go ahead and stick with $500 a month or $6,000 a year. We're going to do that on a $500 per month monthly contribution. We're going to have 3 different investments. We're going to first start off with the S&P 500, and for that investment, we're going to utilize Fidelity's S&P 500 Index Fund, FXAIX. Second investment we're going to use is a dividend ETF. The top dividend ETF that we've found in our tests is the Schwab US Equity ETF SCHD. And then the third investment is going to be my dividend stock portfolio, which consists of currently actually 20 dividend stocks. I'm not going to use all 20. I'm actually only going to use 19 of my current holdings, and I'll explain why in just a second. So 3 different investments over a 20-year time frame from now into the future. Now we have to make some assumptions with these videos because we don't know what's going to happen in the future, and we cannot model reality because the truth is, in real life, the stock price of any of these 3 investments is going to go up and down and up and down and all over the place. There's going to be volatility involved, and we can't model that. But what we can do is take the compound annual growth rate for the price as well as for the dividend in the past, and we're going to take that average, that actual compound annual growth rate, and we will project it into the future, which is going to result in straight line growth, but which is the only thing we can actually model. These are the 20 holdings in my dividend stock portfolio, which is with Fidelity. For the record, this portfolio is actually in a brokerage account, a taxable account, not in a Roth IRA. I've got Eris Capital, Westlake Chemical, Manulife Financial, Star Group Unit, AbbVie, Unum Group, Realty Income Store Capital, First of Long Island Corporation, Gilead Sciences, Walgreens Boots Alliance, MSC Industrial, UGI Corporation, Regions Financial, Genuine Parts, Broadcom, PepsiCo, Johnson & Johnson, McDonald's, and lastly, the Global X NASDAQ 100 Covered Call ETF, which is the most recent holding that I picked up. Just so you know, for Schwab's US Dividend Equity ETF SCHD, we found that the compound annual growth rate from November 2011, till now was 11.46%, and the 5-year compound annual growth rate 12.16%. Now, I do think that 12.16% is probably achievable year over year in the future. Not sure if 11.46% is achievable or not in the long run because we have been in a bull market from like 2010, 2011 through now. Though you should know that the chaos that was involved in the COVID-19 mini recession, if we're going to call it something like that, is incorporated into these figures. And then here for Fidelity S&P 500 Index Fund FXAIX, the annual price change, the compound annual growth rate was 11.63%. Now, the numbers were only available from June 2011 through current, so it's not really reasonable here to expect 11.63 long term, so we'll talk about that at the end. And then the 5-year compound annual growth rate for the dividend is 7.33%. Now, in this test, I did not include Westlake Chemical. I'll show you the numbers that what I projected to be there, which are just stupid awesome. So I'll show you that. But I didn't include Westlake Chemical because it is a master limited partnership, which is acceptable to own in your Roth IRA. However, if you have too much income derived in your Roth IRA from a master limited partnership, which is known as unrelated business taxable income, UBTI, there's too much of that in a given year that it becomes taxable, which you never want to have, especially in a Roth IRA, have taxes due in the middle of your growth period. And that's a possibility here, and it would have happened with Westlake Chemical. So I excluded that from the analysis because it would not be something that an actual dividend investor would include in their Roth IRA. They would want to hold that in a taxable account. So I excluded it, and I instead based it on the other 19 dividend stocks. I did include Star Group Unit, a master limited partnership, but just so you know, based on my modeling and projecting, the income that was being derived from Star Group was never sufficient enough, at least for the majority of the period, to cause any taxable events due to unrelated business taxable income. So what would happen here, guys? Let's take a look at the actual numbers. Based on 20 years of contributing income into this Roth IRA, $500 a month, what would actually happen with respect to dividends and the value? Oh, by the way, the TTM dividends, as you can see on the screen, trailing 12 months of dividends, is based on that 20th year. What would be that most recent year's dividend income? Let's start here with third place. And yes, I'm going to tell you right out of the gate, third place is going to be the Fidelity S&P 500. Here are the numbers. After that holding period, you'd have 377.23 shares based on our modeling and projections. The trailing 12 months of dividends in that 20th year would only be $2,977.41. And the value of that holding would be $528,830.78. And for the record, that's third place with respect to trailing 12 months of dividends and third place with respect to the overall value. All right, next up here, we've got the Schwab US Dividend Equity ETF SCHD. For Schwab, we would have 274.151 shares of that ETF. Trailing 12 months of dividends would be $17,044.13 with a total value of $668,719.70. Let's go ahead and move up here and take a look at the actual portfolio that I have set up here. I'll go ahead and show all this information. We'll review this to see what the individual investments would have done. Now, first thing I want to call out here is this number right here for Westlake Chemical. Now I double checked and I triple checked the numbers here, guys. Westlake Chemical had just stupid amazing numbers here. We got shares owned of 4,904. We have annual dividends, the trailing 12 months of $35,000, and a holding value, mostly due to the reinvesting dividends, of $114,000. Again, this would trigger unrelated business taxable income, so we're not going to include Westlake Chemical. So I already excluded that from the numbers, and I went ahead and gave all these other 19 dividend stocks an equal weighting with the contributions. From a value perspective, some of the outperformers here, we got 52,000 here for AbbVie and Unum Group. We've also got here we've got 37,000 here, 38,000 here for Gilead Sciences and MSC Industrial. And then from an overall dividend perspective, you can see here the NASDAQ covered call ETF had $4,000 in trailing 12 months of dividend income. We've got 33.36 right here for MSM. Up here, we've got 33.53 for Star Group Unit. All of that together here, we take this down to what the average Joe portfolio would have performed. Let's go ahead and release this information here. Didn't actually track the shares. Trailing 12 months of dividends, $24,782.36. with a total value of $585,659.37. So from a value perspective, Schwab's equity dividend ETF outperformed, but from a trailing 12 months of dividend standpoint, the average Joe portfolio outperformed. And what's even better here is if we think about it, this is just 20 years. If you start young and you got another 5, 6, 7 years to invest, this number will continue to compound, and the trailing 12 months of dividend income from that point forward will be in the 30s, 40s, $50,000, where you don't even have to touch the principal balance. And this also assumes that the IRS has not allowed any additional increases to the annual contributions of $6,000. It doesn't allow you to do a catch-up contribution at 50. In this modeling, I just didn't build out that extra complexity. Now, one thing I want to talk about is the fact that these numbers include a compound annual growth rate for the price for both the Schwab Dividend Equity ETF and the S&P 500 of in excess of 10%, 11 and change, which I don't think is realistic in the long term. So what would happen here if we were to take those compound annual growth rates and take them from 11 just down to 10? 10% compound annual growth rate, which I think might be more reasonable, not factoring for inflation. If we come in here, we'll go down to SCHD, we'll change this annual price change, we'll change this to 10%, and we'll do the same thing over here for FXAIX. Now, just so you know, I'm not going to do that with the average Joe portfolio because I actually took the compound annual growth rates for all of the individual dividend stocks back to their origins, sometimes 20, 30, 40 years. So I've already factored in a longer history, which I think is reasonable. So factoring a 10% compound annual growth rate, let's go ahead and take a look down here. So instead, we'd have 3364.99 in trailing 12 months of dividends for the Fidelity S&P 500 index fund, and that's an increase. And then for Schwab, we'd have an increase from 17 and change to 19 and change. And you'll look at the total value here. The Schwab US Equity ETF is almost in line with the average Joe portfolio, 585 versus 587, and the S&P 500 lagged significantly at $434,000. So if we work with a more reasonable compound annual growth rate with respect to price for Schwab and the S&P 500, you can see that the average Joe portfolio performs just as well as Schwab from an overall value standpoint, but more importantly, and the reason why you're probably watching this video, with respect to the dividend income, it's still significantly outperforming the Schwab US Equity ETF. In the very next video, guys, I'm gonna break down for you 5 straightforward, very simple steps so that you can build your very own starter dividend stock portfolio. And then the video right after that one, that's right, we're already planning ahead here, guys. The next one after that, we're gonna talk about whether or not it makes the most sense to dollar cost average or do a lump sum investment at the beginning of the year. I've gotten a lot of questions about that on the channel, so those are the next 2 videos coming up. You don't wanna miss a thing here. We post 2 times a week. I'd post more, but I've got a crazy life going on. I've got baseball for 3 of my kids. I'm working full time. I'm working full time for you guys too. So 2 videos a week is all I can manage. So to make sure you don't miss those videos, make sure to hit that subscribe button below and join the Average Joe investor community. Until the next video, happy investing, and please continue to stay healthy, both physically and financially. Have a good one.